Hello. Hello. Can you hear me? Hello. Hi, can you hear me? Hello. Hello.
Hi.
Hi. Are you okay?
Yes, I am. Yes, thank you.
Okay. We'll start now. Hope so. Technology work for us, huh?
Yeah.
Okay. So let's before starting our lesson, we'll introduce ourselves first, and then we'll start. So please, a bit, introduce yourself, where you're from, what you do, and what
Hi,
you did.
Hi, my name is Maura Collins. I am from Ireland. I do council work, general manager, and I have studied finance over the years in different modules, and I also have a diploma in accounting.
Okay, so which level diploma you have before in accounting level?
And in Ireland, it is actually level 7. I think it might be 5 in your country.
Okay,
There's
brilliant.
a difference of 2, yeah. And I've
Great.
also have looked at investment analysis, but that's in the detail that I see in this module.
Okay, brilliant. Great. Good to hear. Well done. Great. So you have a good background in finance because you have qualification and you have experience as well. So great. Good to hear. So my name is Anjum Satar. I'm teaching with the university around 4 years now, working with Raman. And currently I'm teaching other places like University of Bradford and used to be University of Manchester. Today
Right,
I'm
okay.
Today I'm with you. My background, I'm ACCA partly qualified, MA in International Business Management. I have a degree in accounting and finance. I'm teaching AAT qualifications, CAT, which is called Certificate in Accounting Technicians, and BA in Accounting and Finance. I taught few modules in MBA as well, especially financial management, financial planning, and those sort of modules. Today I'm with you. Hope so. I'll try my best to meet your expectation. If you have any question, feel free. Please ask me. Do not hesitate, and we'll go through. Because it's an hourly lesson, so I'll try to be my best, to summarize things and try to make the terminologies quite simple. But if we want to be further enhance our critical discussion, I'll always copy, some links, So please, you
Yeah.
carry on, and if you have any question, you can ask me. We can go through in next lesson.
I think you can, and also I think you can actually kind of alignment, and it says evaluate the key characteristics of the different types of security, bills and notes and all that. And I think we can kind of maybe focus on that. What is it, question 1.1 and 1.2, and that basically relates to the different types of securities and the strengths and weaknesses of those securities.
Okay, brilliant. Yes, that's absolutely fine. No problem. We'll go through and we'll further, after next lesson, maybe we can further divide into and then we'll go through, all these terminologies as well in full detail. Okay, brilliant. So we'll start. So this lesson is recording, and you will get the recording, will be recorded as well. So we are doing investment analysis, unit 1. is OTHM Level 7 Qualification Diploma in Accounting and Finance. My name Anjum. Satar is my email address in case if you need you want to send anything like assignment to me. So please use this email. And today we'll go through LO1. LO1 is a learning outcome one. For this module, understand different types of security. So we'll go through different types of security, and we have two assessment criteria. Identify types of security. So we'll go through types of securities which we normally uh, issue for to raise the finances, or we can invest money if we have a spare resources, extra resources in these, and we can earn interest on these and extra income other than our normal operations. So which we'll go through and we'll contextualize our discussion in terms of various companies, how they can raise the finances, and we'll go through evaluate the key characteristic of each type. So what is each type of security which we can issue, and what sort of benefit to issue them, and what are the advantages, which we'll go through, because in different countries investment and security is slightly different terminologies used as well, but we'll try to be more focused in terms of UK and in terms of US, in not in other country, because otherwise it will be huge subject and very difficult to be kept in mind all the terminology, because in different stock exchange slightly used. So that's why is more emphasis on the standardization, international accounting standards, and various standards being set up. So we have a same language in accounts and finance, so people can understand better, and we can understand better as well. So that's all about. So we'll go through first what we supposed to be learn under this module, this unit. Before moving forward, we have is the objective of this module to develop our understanding about investment in securities, and we have 6 learning outcomes, and we have a different assessment criteria, and we'll go through assignment brief in next lesson. So today lesson will be focused on LO1, which is learning outcome 1. We have a 2 assessment criteria and further. So it's good to be whenever we'll do any learning outcome, we'll go through inductive contents, what we're supposed to be learned. So bonds.
Assignment, and basically I think I can kind of do most part. It's just the spot rates and in another unit or session.
Okay, yes, your voice is a bit break. So but yes, we'll go through all the way we want. So the bond which we'll discuss, and the key points we need to be focused, the types and the characteristic are different types of bonds, pricing of bond, how we can yield, what is meant by yield, how we can theories of term structures, bond risk, what's type of the risk involved, and how we can minimize those risks, types of characteristic of equity finance and debt financing, two popular source of financing, which will go through what is meant by equity, what type of equity we can issue, and securities, type of securities. So all this lesson will be focused on these 3 points. Any questions?
No.
Okay, great. So we'll start. Okay, so what do we know investment analysis? How we can analyze the investments? Any thought about investment analysis or securities? What is meant by securities?
Well, there's different types. There's, for example, there is bonds, there's notes, there's bills, and they all have different conditions attached to them.
Okay, brilliant. So how we decide, which condition is the best for us? On what basis?
Well, there's basically the short, there's medium, and long, starting off at the actual.
Well done, great. So we can look around the short term, medium term, and the long term objective, keeping in view of, because we need to always look around the organization missions, our strategic objective, and always we need to contextualize our securities when we issue, because if we want to raise a finance, so we need to make sure what are our objectives. So we can contextualize, we can easily, because if we issuing long term and later dates, we have enough money, we need to buy back, it's cost us huge. So we need to make sure, we have the right options, and we will choose the right option based on.
The risks for the long term as well are greater than the short term. And the short term doesn't really pay, it doesn't have coupons. It's just the
Brilliant. Yes, you're totally right.
that's the interest, the kind of the hidden interest. Whereas in the others, they have interest like the what is it, a year up to 10 years, and they
Yes. Okay, great. Yes, well done. So next now we'll go through next slide, which will look now the structure. So if when we look international money market, what is the difference between money market and capital market?
I'm not too sure.
Okay, so money market, where is we issue the securities for less than a year,
Oh, is that what it is? Okay, fine, right, okay,
So
fine.
that's the money market. And the capital market is a capital, like maybe you learn already or you heard about. What is the
Yes.
difference between capital and revenue expenses?
Revenue expenses are day to day. It's
Yes, well
assets,
done.
and you post for every day to day, and there's a depreciation that comes off those into the as part of the period cost. I went through it.
Excellent.
The balance
Great.
sheet and transfer
So
it into the
brilliant. That's all. So capital expenditures is a long term, which goes in the balance sheet, and revenue is a day to day, which is a part of statement of profit and loss. We call income statement as well. So today lesson really will go through the financial instrument which we can use, the role of money market and the role of treasury function, which we'll go through the financial market, capital and the money market. Maybe we heard about primary market and secondary market. Primary market,
primary market is first. Is that the first time you kind of sell them?
yes, well done. That's all about, first time we'll
Brokers
trade.
and things like that.
So
The secondary market is the second time they've been sold. Because there you have these kind of agencies or
yes,
that's
brilliant.
the secondary market.
All brokers and things, yes, where we
Yeah.
second time we can sell and buy. Okay, so then we'll go through the source. Yes, hello.
Yeah. The second to do with entity.
Yes, intermediary. Yes, in between agencies and things. Okay, so well then, sources of finance, equity and debt.
That's right.
So two major sources of finance. One is, if you want finance, equity and the debt financing.
That's great. I mean, I've heard all this before in other modules. It's great. I didn't realise that this was kind of going to be part of this. It's brilliant.
So which one you think is a cheaper source of finance?
Oh my goodness, yes, absolutely. Because in the case of equity of shareholders, you have to pay them. Well, I mean, they can. Then they have to stay in. They can actually earn more. If you make more profit, down to the directors decide basically, whether to pay a dividend or not, or whether to invest it in return. Earnings are debt, and you get it from a bank or building society or whatever, and you pay so much principal and interest.
Mm-hmm. Yes. So we look the debt normally near to many analysts. Debt is cheaper than equity. Debt is less costly than equity. Equity is a long-term commitment. You are losing as a voting right your power as a company, because your more shares issues, it will be affect on the value of the share.
Yeah.
So we need to look around. We need a balance. So a lot of analysts say 60% debt and 40% equity. We need good balance. But the benefit of the equity, if you're not paying it, you're not paying them dividend. It's it's entirely up to you. If you're not earning, you
Yes.
don't need to pay. So, but is a debt is a commitment. If you missed it, you will be badly publicized in terms of, the value or the goodwill of the company will be going down. So we
Yeah.
need to be make sure we have a right balance between debt and equity. So which we'll go through some models later, when we'll go through the LO6. Okay,
For big
so
companies, for big companies, it's normally around 50%, isn't it, breaking to kind of
we can argue, yes, is a different industry to industry, different objective to objective, different if you when you register the company with the company house, so you're supposed to be registered your capital, and if your registered capital is less now and you need to raise more money, you go more debt financing in term of, but overall the debt is less costly, like you maybe get 2%, but the shareholder expecting more than 10% because that's why they are investing in shares.
great, excellent.
So that's all about. Okay, so next now we'll focus on when we're looking the financial market. So deal in the long-term fund is the capital market, and deal in the short-term fund is the money market.
Yeah.
So financial markets provide intermediation, so we can look around, and the primary and the secondary markets as well. We have allow diversification, shifting of risk, hedging. Have you heard about?
Protecting. Yeah, protecting basically where you kind of, interest rate.
So hedging in terms of foreign exchange, we can hedge. So the currency, if it's a fluctuate, we're not going to lose the money like in terms of no Brexit and uncertainty. So we need to make sure, if we're dealing in one thing, we can deal in different currencies, so many different currency, we're not going to affect it. Second, we can hedge it by using the hedge agreement with the banks or different institutions. So if the currency will go up and down, it won't affect us, but it's quite costly process. So we need to really look, that's why the company deals in different currencies as well to minimize the risk. Okay. Next, now we're looking the security. A financial security is the document really we're looking of the certain monetary value. It refers to the stock and the bond with the negotiable derivatives, which is also considered as a common types of financial securities with its growing popularity in recent years. Yes, we heard a lot these about securities. We heard about Eurobonds. We heard about various other types of the bonds. Equity securities holding an equity interest mean the contribution to the capital. Equity mean the capital is mean the share capital. Equity, the shares, we have two types of shares we can issue to the public to raise the financing. Sorry, which one those?
Sorry?
Do you know the types of shares? How many types of shares we can issue to the public?
Yeah, ordinary, which are kind of, they have,
I guess
basically.
And
then
there
you
is
have different types of preference shares as well. You have cumulative and you have redeemable preference shares as well.
well done, great. So ordinary and the preference, the key difference between ordinary shareholder have a right to vote and the preference shareholder don't have a right to vote. So preference, when we liquidate the company or when we declare the profit, we give the preference to the preference shareholder. They normally have a fixed rate of interest. So fixed return on their investment. So we give them preference to, and the debt securities is the different types of the debt securities such as bond, debentures. Debentures is also sort of the bonds.
No.
Sorry,
it's sort of a loan, isn't it? The debenture.
yes, is a sort of loan, yes, because it's a debt financing. Equity is a share, and the debt is all other types of loans which we get, through it's come under the debt financing. So these all we use to raise the finance. Any question?
No, absolutely. It's great. It's fantastic. And as I said, I covered in other modules. Goodness, it makes it so much.
Brilliant. Well done. Great. So next we're looking now. Money market.
It could be tough for anybody that hasn't module. I say to be tough going, in some
Okay. Great. So money market comes all these companies. Yes, those participate include their participant. Okay. Next, we're looking the capital market. Deal in the long-term finance, which is we already mentioned. Yes. So which is public sector and the foreign stocks, companies, securities, shares, and bonds. Euro bonds is example of international capital market, domestic funds, like recently EDF electricity plant, which is supposed to be atomic electricity plant. That's all about the capital. They issued the investment in it long term, the shares of Chinese companies. So that can
Sorry,
be
what is
example.
that? Sorry, what did you say there? What do you call it?
EDF is called Electricité de France. They are supposed to be, it's a project which is atomic electricity they're supposed to produce, and
Great,
it's a quite million pounds project, and the investment is from the Chinese company, from UK government, and the EDF itself. So that is and the issues. So that is called sort of the capital market because it's a long-term project. So euro market, foreign bonds. So what is a bond? Bond is a long-term debt, usually in the form of debenture or the loan note, is a frequently used as a source of long-term finance and alternative to equity, and the bond is a written acknowledgement of the debt by a company. Bonds also known as a debenture of the loan or the stock, the traded on the stock market in much the same way as the shares. Yes, normally denominations can be £100 plus. Secured debt will be carried as a charge over one or more specific asset. It can be secured, it can be unsecured as well. There we can look around this, and redeemable.
secure guarantee or something. Unsecured then is basically where kind of they're paid after.
Yes, secure is mean the pledge against the assets, and unsecured is not really secured about. Yes, so is a risk involved. So it's supposed to be more return on, because we use in the business, we'll say the risk factor is called beta. With the higher the beta, higher the risk, higher the return.
Okay, yeah, I've heard of that. Yeah.
Okay, so that's all about redeemable, irredeemable. Then we use different types of bonds. There are the many different types of bonds available. However, there are a couple of common types of you should aware of. Deep discount bond, we heard about before.
Sorry, which?
Deep discount.
I've heard about discount. Yeah, where as I said, the face value.
Yes, these are the loan note issues at the price is a large discount to the nominal value, and which is redeemable at par or above than the par value. Par value is also known as a face value. In shares, we can call it the nominal value, the value which is written on the face when they eventually mature. The lower initial price paid by the investor in the balance against the lower return and the coupon rate offered on the bond, and much of the return gained by the investor come from the capital gain when the bond is redeemed. Zero coupon. What is meant by coupon or coupon we call?
It's kind of a sort of, as it's kind of where you earn so much 2 times a year on the actual on the bond.
Yes, it's like a little, the piece of paper is attached with the bond, and you can just peel it and you take to the, and you can get the money. Like, the national saving investment schemes, normally you have a coupon as well. So you can go every month and take to the post office, and you get your interest on it. but the principal you carry on keeping. So these are the bond issued at the discount and their redemption value, but no interest is paid on them. Any question? Okay. Next we're looking hybrid and convertible. Have we heard about?
Convertible bonds are basically, I think they can be kind of converted into cash.
Yes, it can be converted into, depends upon our term and condition. It can be converted into the various.
Hybrid, I can't remember, but I'm sure when you say it, I will remember it.
Normally, hybrid is mean more flexibility, more changing. Hybrid cars are we seeing hybrid things? Yes, more you have a more options things.
Okay, great. Yeah.
So normally, ordinary shares are either predetermined price, nor maybe convert into the shares at the value of yes. And predetermined ratios, we can say every £100 stock may be converted into 25 ordinary shares. Conversion is a premium occur if the market value of convertible loan is greater than the market price of the share the stock is converted into, and the stock trading at $102 to be converted into the 10 shares currently trading at 9. So as the conversion premium 110 minus, because the 10 was yes, so 9, so £1.20 per share. Any questions?
You have it to the ordinary account, to the share account.
Yes.
Into the premium account.
Yes, of course, we are giving you option you can convert, because when the share price goes, you have option to convert into the shares. You don't need to keep it. Yes?
Yeah.
Conversion is there. The floor value of the convertible loan is the minimum the market price of the note. Since is the cash no value of the conversion, it can be calculated at the present value of the future interest payment plus the present value of the, we know the present value, yes? We learn about investment appraisal, where we learn about the net present value, NPV, the future cash flow, yes, based on the discount.
Yeah.
So what money we'll get, what will be real value. Okay, next we look at the loan note with warrants. What is meant by, so the warrant give the holder the right to subscribe at the fixed future dates for the certain number of ordinary shares at the predetermined price. If the warrant are issued with the loan note are not convertible into equity. Instead, bondholders make cash payment for the share and they retain the loan note until the redemption, and often use sweeteners on the debt issues, and the interest rate on the loan is lower, and the loan may be unsecured, and the right to buy equity set at the attractive price, and the bondholders can sell the warrant after buying the loan notes, and thereby decreasing the cost of the buying the loan notes. Does it make sense?
Absolutely, yeah. No, it's fine. Yeah.
So next, now we're looking attraction of the convert and the convertibles and the warrants. So
exactly. Okay, fine. Yeah.
So what are the reasons behind? So we can look around the reason. Of course, we have advantage for it. That's why we use this option. So that's why the financial analyst or the financial controller plays significant role in the organization.
Okay, yeah.
So these are all options. So next we're looking at the bond. We work through the same numerical example, inverse the relationship between market price of the fixed interest government bond and the yield on those bonds. The government bonds are the fixed interest security. This means the bonds pay a fixed annual interest, and this is known as a coupon. The coupon paid can be in different currency is a fix, but the yield and the bond will be varied. The yield is effectively the interest rate on the bond. The yield will vary inversely with the market price of the bond. When the bond prices are increasing, the yield will fall. When the bond pricing are falling, the yield will rise.
Right. And that's the inverse relationship is to the opposite kind.
Yes. So we'll go through this example that will be clear our concept further. So we'll say the nominal value of the bond is 5,000 and pay annual fixed interest, which is 200. The yield as the percentage of the bond, we can calculate yield. Interest on the bond divided by the market price times by 100. So is a 4%.
Yeah.
So if the price rise, market price, no, the market price of the bond is 5,500. Still we'll get 200 interest. That's fixed. 200 divided by 5,500, 5,500 times by 100. So it's dropped down to 3.64. So which is the proven when the price will increase, the yield will drop.
Yeah.
Okay. Then I copied the link, this one, to further reading, because if we can copy this link and we can read further about the bond and with lot of examples. So what we can do, we can copy this and we can is the ACCA article bonds, yes, the warrant examples and the yield, yes, with the present value in the cash flow after 1 year, after 2 years, after 3 years. So these are all good examples to further enhance, our understanding. So if any question, we can try to address, Okay, so next now, can you see the slides?
I'm just coming up now at the moment, but I wasn't able to see the slides up to now.
So
the slide.
So next we look at the financial institution, which is called intermediation. Here, intermediaries company. So the role of this can be risk reduction, aggregation, and maturity are transforming things. So that's help, in a organization. So we can look around the financial securities. Money market instrument can be CDs, repos, treasury bills, commercial papers, bankers acceptance, FRAs, caps and flows, interest, all have advantages and disadvantages. Yes. So
great.
We can pick, and we can discuss. Okay, then the treasury function, the role of is the banking, foreign exchange, cash, currencies. We can raise finance, risk and insurance, short-term asset investment, and it can be centralized or decentralized. So keeping in view of both have advantages and disadvantages depend upon the size of the organization. Yes. Okay. Next now, currency risk.
Yes.
Currency risk can be transaction, a risk of the exchange rate. Translations exposures can be the change in the value of the subsidiary if we have a subsidiary due to the change in the exchange rate. Economics, it can be the loss of the competitive strength due to the changes in the exchange rate. So these can all types of the risk can be. So we need to make sure we'll really forecast. Okay. Next our area of discussion is the shares. New shares we can issue, placing, offer for the sales. We can offer for the sales by the tender. We can through the intermediaries, companies, brokers, right issue. What is meant by right issue?
Is that where they've been issued before? Is it? It's not the first time, is it? It's where they look for money. I know.
What is meant by bonus issue?
The bonus issue is basically where I think it's where people already have shares and they can actually get extra shares at reduced price. Is that the one?
Yes, sometimes we're not giving the dividend. We say we'll give you as a share bonus. Yes.
One off. Is it once off?
So right issue is you have the shares we can issue you more, or we have a right as a company to register. So right issue, the existing shareholder have a right to subscribe the new shares issue in the proportion to their existing holding.
Yeah.
So theoretical X price, which is the price, yes, the value of the existing shares plus the proceed from the issue and divided by the number of shares in issuing after the right issue. So value of the right, we can theoretical X price minus issuing price, and the value of the right per existing shares, value of the right divided by the number of, we'll go through some formulas in the later stage when we'll do some numericals. Yes.
The rights issue doesn't dilute the shareholdings because they're given it if they take up the offer, they're given it at the same percentage or ratio as the shares they already.
Yes. So depends, whatever our agreement will be. So every 5 you are entitled to take one more. Yes.
Yeah.
You have a right to. So what will be the X theoretical price? Basically, whenever number of shares in issuing will increase, the price will, effect will be on the existing shareholder. That's all about it. So next we're looking the debt versus equity. Equity shareholder own the business and the voting right. Debt holder don't have. You already know. Yes. Risk is a lower risk for the debt holders. Yes. High risk for the company, and equity is a high risk for the shareholders and low risk for the company. Return, debt is the holders will accept the lower return due to the lower risk, and the equity holder want a higher return to compensate the higher risk.
Excellent. Yeah.
Okay, then nowadays, sometime in our syllabus carry on coming, and a lot of banks is offering now. It's
What
Islamic.
Is that? I don't know much about that. What is that? Islamic?
It's Islamic financing. When we raise the money, like we do, are not so. A lot of companies like HSBC Bank, Barclay, Lloyds, and various others now, they have started Islamic financing because the people, it's based on the belief, they don't want to pay interest on it.
Okay, right. No interest. Okay.
Interest is called in Arabic is riba.
Right. Oh, how do you spell that? RIBA. Okay, fine. Yeah.
Riba is prohibited in a belief. So as a religious point of view, so what they do, instead of interest, we can replace with the cash flow from the productive source, such as the return from the investment. So in really Islamic belief, they don't have a belief the fixed interest on it. They say the profit, it can be go up and down.
Right. Okay.
So you buy things and it can be go up or down, doesn't matter. Yes.
Yeah.
So that's investment activities. So when these are the key terms the bank use. One is called Muarba, which is mean the trade credit. Ijra is called the lease finance.
Okay, right.
They use the term. Then the debt financing is called Shukku. Yes.
Oh my God.
Then other is called Mudarba. Mudarba is the equity finance. Equity finance is you are buying asset, you're investing in asset, it's yours, you're owner of it.
Yeah.
And Mozarka is a venture capital. Just a different terms, in Islamic point of view, they just use. That is Islamic financing. But only the key difference is that you don't use the word riba and don't have a fix on it. It can be varied based on the value. Okay, so that's all about, and estimating the cost of capital and the dividend. So always we need to look around the cost of capital, what will be, in the dividend valuation model, which will go through some model later dates in our, especially when we'll do LO6. So cost of capital and the dividend evaluation. Always we need to be in our organization consistent dividend policy. Don't give the dividend higher in a year and then you drop significant. When you drop, the satisfaction of the shareholder will drop. So their expectation is very high. Don't put their expectation don't very high, because the next year never know, the profit will drop and you can't afford it to pay them. So always keep it. And so dividend, we can constant dividend. So P naught we always use for the ex dividend market price of the shares, which is we normally use the base, and D is the dividend, and RE is the cost of equity, how much worth of equity. So that's all, we can use the formula to calculate the growth of equity, which the dividend evaluation model consistent growth that we can use to calculate, what is the growth rate there. So we need a consistent dividend growth. That's we use the evaluation model. Debt, cost of debt is always, earlier we said we can prove this because the debt, interest cost on the debt is expense for the business, which we can minus from our profit, and which is a lowable tax expense. So that's we reduce our profit, and by reducing our profit, we'll pay less tax and we'll save on the tax as well.
And
so that's why the cost is less, than cost of equity, and we can claim more than. So that's all about that can be convertible. Like earlier, we need to look around what will be gearing ratio. Always need to be look around. We know the gear mean when you drive the car in a high gear is a high risk. If you have a high debt is a high risk as well. Yes. So we need. So fixed cost divided by the total cost. And the change in the interest before interest, EBIT is in earning before interest and divided by the change in the turnover. So we look the both years changes, and we can look around what effect will be on financial gearing. We can look around equity gearing. We can look around the total gearing by using the formula, and interest gearing as well. Debt interest plus preference dividend and divided by. So this way we can find what effect will be on the gearing. Next, these are normally in term of just a US trade security, different types of security and department issues in US. Yes, is a good background reading type of securities. Yes, treasury bills, treasury notes, and the bonds, like earlier we said. So that's why I left here these slides. These are the old one, but it's good to be read, Yes, primary market and the fact. So the coupon and the security, the quoted, unquoted, zero coupon, like earlier we got the theory. And then we normally do a little quiz. It's not a quiz, yes, to just do and a bit, increase our understanding about the concepts. So if you type, just 1 second. Can you see on my screen?
Yes. Yeah.
So we'll play a few questions, and maybe later on we can. We're looking the financial markets, and where we'll go through some terminologies. So if you type on your screen, just type, Kahoot it, please, in a search box.
What is it? K-A-H?
Yes, KHOOT and .it, IT.
T, is it?
Yes.
K-A-H-O-O-T. What else? I-T. Yeah, okay, fine. Yeah.
And the box will come where you need to enter the PIN number.
When will that come?
This PIN number.
Okay, I don't see it.
So you can't see, sorry. So can you see now?
Okay, yeah. Where are you into that?
Yes, type Kahoot
Yeah.
.it, and then will come, enter the PIN number. You enter this PIN 355632, and then you enter your nickname or your name, whatever you want. You managed?
No. Where? Where? Wait, what player it says? No,
No.
not working. It's not working. Not working. No. Where do I put this? I can't see how to enter this. Not working.
So have you typed it Kahoot.it?
Where do I put it in?
Just a Google search, or just type, simple at the top of your this your bar. Just type www.kahootit. Like if I'll show you here, if I'll like here www.kahoot. If I'll type it, yes.
Yeah.
So it gave me this little box. Yes, and then enter the PIN number. Yes, you're there now. Huh? Okay. So it's not a test or anything. You will see the question here on my screen, yes? And you can pick the right color, which is the right answer, huh? And you need to tick. And it's a time, we'll start. We'll play with it, huh? So interest that built up, it's over the time, what we called. So please, you need to pick from these colors, which one you think. And you need to take 7 seconds left, 6.
Okay.
It's called compound interest, yes?
Okay.
Don't worry, just try next now.
Next, okay, how do I pick next? So get over time. How do I go to the next one? How do I go to the
Contract.
Contract.
So you can quickly pick,
Sorry, contract.
It's called bond, yes? So you need to pick the color, huh? Which of the following, which one is the best rating bond? Bond rating can be AAA, triple B.
Okay. A is the first one.
So yes, you need to tick the color. You need to tick on your screen, where you where you tick the Kahoot. Yes, like I'll show you here. You enter the pin numbers, yes, and your name, and underneath is your color coming on your screen. You just need to pick the color, huh? That will be your answer, and you will get the points. High risk bond also. Which term we use for a high risk bond? Junk bond. This time you ticked. Well done. Oh no, you didn't tick. Are you getting this color in your screen after this entering? If you click other bar, yes, this one where you enter your names and things, yes. So what?
I'm getting it.
I'll play one more, huh?
It's coming up. You do any?
Yes, on your screen is coming red color municipal.
Yeah, on my just a recross 0 mark across it.
It's called mutual fund.
Okay. I didn't know that. I know now.
Okay. On your screen when you enter your account.
What I'm getting is time's up, and it says kind of a thing. You're in first.
Okay. I will pass you role. You accept the new role, and I can see yours. Huh? It should work because that's quite good, to play the quiz. And I increase, because our understanding these, I created few questions. So if you look now, just a minute. Have you accepted presenter?
Share your screen. That's what I'm getting. Yeah. I can't do anything. So it says share your screen.
No. I think so. Not coming anyway.
Yeah.
Or maybe you log in on different system. Anyway, that's fine. We'll try next time. Huh?
Yeah. There's a play Kahoot. It's come up as a big cross, like a wrong cross. Time up, it says.
Okay. Yes, that's fine. No problem. So that's the way we can, and I'll send you a few links. So we'll back to our lesson. Okay. So that is sort of to just check our understanding, and I'll download and I'll send you the quiz itself. So that's we have. Today lesson we learn about identify the types of security and associated concept which we discuss. Different types of bonds, different types of security. We evaluated the key characteristic of each. So each type of security have own advantages and disadvantages when we evaluate it. So this 1.2 will be addressed.
Yeah.
Okay.
Basically, this particular lesson 1 answers the question for the assignment.
Yes, we will go through answers according to the assignment question in next lesson.
That's what you've done, brilliant. It's absolutely, it has every single thing. I remember years ago.
Hello, sorry, your voice is a bit break,
Yeah,
so I'm hearing you properly.
And it's coming back to my memory when you're talking about the different things. I was, calling all of that in my memory, which is great.
Okay. Thanks. So what we'll go through when we'll do our assignment. So that's which we discuss CD and all. So trade bills, we can explain these all been discussed. Huh? So
Okay.
so these are the terminologies. Yes. Trade bills. So if I want to further read it on the trade bills, yes, I can send you the separate handout for these all, separate.
Brilliant.
But we can these we need. Yes, what is meant by. So what I can do, I can maybe separate handout. I can explain. Yes, current deposit. Yes, like if I'll type trade bills for suppose. Yes.
Yeah.
So if you type Google, there normally I use the website. Okay.
Yeah.
Okay, you will see now my screen. Huh?
Okay. Yeah.
So like we can Investopedia is quite good. Yes, always is good to be because with this for us we can use the. I'll show you. A trade bill is the short-term debt obligation. Yes, backed by the U.S. Treasury Department with the maturity of 1 year or less. Yes, that's meant by and why they do. Yes.
I mean, if you had money to kind of.
Yes, the maturity date is a less, short period of time. Yeah, it's deal with the inflation. Have to be compete with the inflation. Yes. So that's all. So when we'll pick other first for next is CD. So if I'll go back.
Yeah.
So all these terms. CDs. Like if we are comparing CD versus CD, the income received exempt from the federal and the state income tax. Yes, the maturity date CDs varies from the financial. CD is called is a depositor.
Yeah.
So that is all about it. So you will see there what is the rates about this. Yes.
Right. Yeah. Thank you. Yeah.
So that's the way, and all these terms we can. Basic is all bonds. Yes, different types. And some already been explained here. Yes, advantages and disadvantages of each, like zero coupons and various others. Yes, quoted or not quoted, trade bills. Yes. Okay, so just we need to go through these and then we'll be absolutely fine. So we'll address our hello. So what I did, I'm going to send you our this article as well. Revision on the bonds market, debt security sold by the government. Yes, fix the yield. There will be, so what we can. So I'll try to send you one or two more articles. So normally when you type something, any financial things, if you want, first suppose I want something about bonds. Yes. And next to that, if you type Kaplan is a quite big publisher. And it's any topic or anything really specific regarding finance. It's come debt, what is a debt financing, what is a bank loan and overdraft, what is a bond, yes, and the loan notes. So my slides most are coming from these resources, yes. And we use ACCA resources. Sometimes I'm embedding. Yes.
How did you find the ACCA when you were studying?
Sorry.
How did you find it?
ACCA is quite good. It's quite so just one second. I'll stop this recording so then we can chat. Okay,
Great,
so this is all about. So today we learn about the types of securities, associated concept, evaluate the key and different types of securities with their advantages, disadvantages, and is lesson one. We covered LO1, and my name Anjum. If you're just listening, please just drop me email if you have any question. I'll get back to you and as soon as possible. And hope so. I'll see you next lesson. Okay.